Charles Ponzi's original scheme started with a surprising twist. He targeted working-class immigrants like himself, who were desperate for a better life. But little did they know, Ponzi's plan was built on deception and greed. So what really happened? As the scheme grew, Ponzi's investors included his chauffeur John Collins and his own brother-in-law, who were among the many who fell prey to his promises of high returns. But the numbers didn't add up, and it would have taken 53,000 postal coupons to actually realize the arbitrage profits for the initial 18 investors of January 1920. Meanwhile, Ponzi lived luxuriously, buying a mansion in Lexington, Massachusetts, and a locomobile, one of the finest cars of that time. But as the scheme continued to grow, suspicions began to rise. A Boston financial writer suggested there was no way Ponzi could legally deliver such high returns in a short period of time, and Ponzi sued for libel and won $500,000 in damages. However, this only brought in more investors, and Ponzi was making $250,000 a day. However, not everyone was convinced of Ponzi's legitimacy. Post-acting publisher Richard Grozier and city editor Eddie Dunn were suspicious and assigned investigative reporters to look into Ponzi's operation. Meanwhile, Barron observed that though Ponzi was offering fantastic returns on investments, Ponzi himself was not investing with his own company. The investigation continued, and it was revealed that Ponzi was at least $7 million in debt. Meanwhile, Bank Commissioner Allen seized Hanover Trust due to numerous irregularities, foiling Ponzi's plan to borrow funds from the bank vaults as a last resort. Ponzi's certificate of deposit at Hanover Trust, which had been worth $1.5 million, was reduced to $1 million after bank officials tapped into it to cover the overdraft. As the investigation continued, Ponzi surrendered to federal authorities and accepted Pride's figures. He was charged with mail fraud for sending letters to his investors telling them their notes had matured. However, the damage had already been done, and Ponzi's investors were left with significant financial losses, receiving less than 30 cents to the dollar. Ponzi pleaded guilty on November 1, 1920, to a single count before Judge Clarence Hale. He was sentenced to 5 years in federal prison. The news brought down 5 other banks in addition to Hanover Trust, and Ponzi's scheme was finally exposed.